As expected at 12 noon, WPI is out. The Feb WPI inflation has come in at 2.93 versus estimates of 2.9, exactly in line with what the street was anticipating. The CPI number was also just marginally above, so I think it doesn't come in as a surprise. Rupee is 12 paisa here and there, but below the 70 mark as far as rupee goes in terms of inflation. 2.93 is the number. Let's also just pull up the bond yields. Bond yields will be reacting to two things. One, what RBI has done with terms of liquidity, and second, of course, the WPI number. Now, okay, Maithili Bushnumad is now with us. Maithili ma'am, 2.93% is the WPI number for Feb. We are awaiting the breakup. Your first thoughts?
Well, yes, it is very much in line with expectations. And as we saw with the CPI, there has been a move upward tick because the WPI for the previous month of January was a 10-month low. CPI, in fact, for the month of January was a 19-month low. So we saw February CPI inch up, and you're seeing WPI also inch up. In fact, for the first time almost in India, we're quite happy to see inflation inch up because low inflation also has its downsides. So that rise in WPI to this number of 2.93 is not surprising. In fact, it's very much welcome at the moment, because hopefully it means that some of the distress caused because of very low prices, particularly primary product prices, is at last getting reversed.
Right. Just in terms of the breakup that we are getting now, just wanted to read that out. Fuel and power inflation is at 2.3% versus 1.8 in the month of Jan. That's gone up on expected lines. That's the only breakup I think that we have at this point of time. Maithili, also, what do you make of the RBI measures for liquidity yesterday? You think that is also something which is impacting bond yields and currency today?
Oh, well, definitely. In fact, this is something that has been long awaited from the Reserve Bank of India, because the Reserve Bank of India's OMOs, of course, under the new governor, OMOs had speeded up. They were more frequent, they were larger. But despite all that, OMOs, by their very nature, tend to inject only short-term liquidity. Clearly, the system was in need of more durable liquidity, which is why the RBI has now shifted to a better tool, as I would call it. 5 billion is not a small amount. On 26th of March, the RBI will be buying this, and they will be reversing it over a period of time, over a period of 3 years. So it gives some comfort to the market that there will be durable liquidity, because remember, deposit growth also has not picked up very much, and we are seeing credit growth finally pick up. So the system was tight for liquidity of a more durable nature. So this is a very good move on the part of the RBI. It's a preemptive move to ensure that liquidity does not tighten further, because even though the RBI had cut repo rates in its previous monetary policy statement, the fact is it hadn't really translated into much of a decline in price in either in bond yields or in fact in lending rates of banks. So this is, I think, the RBI's attempt to ensure that better transmission happens.
Give us a sense of how you're reading into the overall macroeconomic picture. We earlier had the CPI, IIP numbers come in. CPI hardened to about 5.4% odd. IIP growth softened. Now with the WPI firming up a tad bit, how is the overall picture looking like?
Well, not too good for a government going into election, because we seem to be at some kind of a low-level equilibrium. Because though it is good that inflation is down, it's well below the RBI's 4% median target, because under the monetary policy inflation targeting regime, it is 4% midpoint plus minus 2%. So 2% is the lower end of the band, and we've been perilously close to this 2% number for quite some time. It's time we moved up. At the same time, we see no sign really of growth picking up. IIP, particularly manufacturing, is still very in the low numbers, dismal, whether you're talking about 1.7% for IIP as a whole, and manufacturing again not doing well. So I think that overall we seem to be stuck at a low-level equilibrium. Unfortunately, because of the Model Code of Conduct, the government's fiscal levers are very limited. It cannot do anything more. So the entire burden really has to be carried by monetary policy, which is why we're seeing the governor step up to the plate and increase liquidity, cut repo rates, because the next cut in repo rate, unless it's an out-of-policy cut, can only happen in April. And that might be too late to give any kind of kick to the economy. So we're seeing whatever the RBI can do in terms of liquidity measures. Whether this will suffice to pick up in growth is, of course, a big question mark. It might be a bit too late.
Ma'am, just when we look at, the few changes that have happened in liquidity, the sudden rush of FIIs, India has again started to outperform. What is the sense that you get when you look at the liquidity situation overall? The sort of measures that have happened. All of this is pointing out that valuations can go up.
Well, it does look like that because after the initial fears about the Indo-Pak face-off, things seem to have receded, fears and worries seem to have receded, and clearly the Indian market is now playing catch-up. Markets, of course, are always forward-looking, so the kind of run-up we've seen in the markets, it seems to suggest that the market feels that we are going to get a stable government, perhaps with the BJP in a pole position, and that the market is always seen as good news because the BJP is typically been seen as more friendly to the market than an alternate composition. So clearly the market is playing partly catch-up, partly forward-looking, building perhaps whether on hope rather than expectations or whatever you want to call it, experience. So the fact is that with the easing of liquidity, I think we will perhaps see markets again sustain this kind of bull run. We were also seeing, in fact, yesterday, day before, we saw a sharp increase in the bank nifty. And given that banks are a very good mirror image for the economy as a whole, when you see bank stocks running up, that means the overall view of the economy is positive. So though we've been talking about the economy having bottomed out for a long time, hopefully this time it is here to stay and we are seeing a bottoming out. Remember, elections also are big spenders. During election, we see this huge boost to consumption. And though investment may take a while to pick up, hopefully it will not lag far behind consumption.
Okay, we also have another guest joining us right here on the show. Sanjeev Narang is here to give us a perspective on the numbers that are just been released. Sameer Narang, I'm sorry, pardon me. WPI inflation has come in at 2.93% versus ET now estimates of 2.9%, so very close to what we were expecting. What's your understanding of the number?
So, well, the number has gone up a little bit from the last month's reading. So was the case with CPI. You're seeing an uptick, a mild uptick in food prices. Food prices had been deflating a lot, led by veggie prices. So that trend is turning around a little bit. And I think what you should see is that food inflation inching up a little bit as you go into the year. Because last year the food prices actually have deflated quite a lot, so there should be some catch-up which should happen. At the same time, the government policy of higher MSPs should ideally play out in prices in the coming few months, though we should remember that Indian prices are still far higher than domestic international prices for wheat. At rice, we are pretty much at the same level as global prices, so a little room is there to go up, but not a lot, because there has to be some parity with global prices. At the same time, in CPI we saw core inflation remaining sticky. In case of WPI, the recent run-up in the currency should be a positive and ensure that the overall WPI doesn't go to a very significantly high level as you had seen last year, because oil prices had run up. So this year on an average oil prices are at lower level than last year, so you're pretty much all right in terms of the outlook for CPI and for WPI in the next couple of months. So this does give a room to RBI to ease further, because the global growth outlook is quite patchy and doesn't look too optimistic. So there is room for monetary easing and reason for monetary policy to support growth, because inflation is looking within RBI's target.
Ms. Narang, I have actually two questions for you. One which is purely economics, in the sense that even if the RBI were to cut repo rates, and maybe even by 50 basis points in April, when can we expect growth to pick up? That is my first question. My second question is more on the political economy. You know, all governments should normally be very happy to go into election with inflation very low. This time we have the rather strange situation where the low inflation number is not really very good news for the ruling party, because it has also meant rural distress. So which way would you look at it? Two questions, one purely economic and one political economy, Mr. Narang.
Yes, so I think on the first part, when would growth pick up? You should see rural consumption bottoming out now. You should see mild pickup in rural consumption as the income transfer programs starts its work and starts oiling the rural economy as you go ahead. The second thing which really powers the rural economy is construction, and you're seeing reasonably good growth in construction. So that those two things should help the rural economy in the next couple of quarters. Prices at the same time with government procurement has gone up. If you look at food stocks with FCI and government, they have gone up compared to last year. So government procurement is also increasing. All these things do point out towards a bottoming out for the rural economy, and it should do well. But at the same time, it will take time, because there is a lot of overall stress that has been built up in the system in the last couple of years, which has been more or less cleaned out now. The banks are much more capitalized. They are in a position to lend. You are absolutely right. There was a liquidity shortage in the system, which RBI is tackling with the swap that it has undertaken, the announcement that has made yesterday and to be undertaken on 26th of March. So there are these measures to boost liquidity and ensure that interest rates are lower. So that should lead to improvement in overall growth, but that will come with a lag of at least 2 quarters. So you should see H2 where things should start looking up. On the second part, what you're suggesting in terms of the political economy, I think yes, you're right. There is, I would say, a golden rule. Maybe 4% inflation is optimal, and we are running far below that. Particularly food inflation has been far lower, and that also leads to much lower producer prices. And so a lot of so what has essentially happened is that farm costs have been running at a much higher percentage growth compared to the remuneration in terms of output, and that has caused a lot of distress. If you look at the overall farm credit to farm GDP, that has also gone up. So on an overall basis, there has been over leverage, and farmers couldn't repay, and prices were not, the output prices were not increasing in line with cost. So overall that led to some distress, and that should improve as you move into the next couple of quarters, because the government has actually done a direct benefit transfer. So on an overall basis, I would say things would have been much worse if we wouldn't have seen a direct benefit transfer. With the direct benefit transfer, it elevates the problem somewhat. So I think the government should hold okay now.
On that note, Snarang as well as Maithili Busnurmath, both of you, thank you so much for taking time out to chat with us about the numbers that were just released for the month of February. This is the WPI figure, and of course giving us a better insight into the macroeconomic picture of the country as it stands.